we got some overview here. Now, who are related parties? That's definitely important to note. Related parties are going to be direct family members, such as a spouse, children, grandchildren, parents, and siblings. These are all considered related parties. However, in-laws and step-siblings are not. So something to memorize to know. Entities in which an individual or another entity owns more than 50% directly or indirectly are also considered related parties. We'll see plenty of examples as we dive through the entire lesson of all of this. Ownership: if an entity A owns a percentage of entity B, which owns a percentage of entity C, entity A is treated as having ownership in entity C. So again, A owns B, B owns C, and we will see numerical examples of this. I'm not just going to spew all of this and expect you to understand. So it's calculated as entity A ownership in B times the entity B ownership in C. That is going to equal the entity A ownership in C. Now, feel free to plug your own numbers in here, but again, we will see examples. Individuals in the same family must net their interests together, whether it's corporate entities or individuals. We'll see this as well. It's assumed to be owned by one shareholder. So if me and my brother each own 25% of a company, it's constructively considered 50% ownership because we're related parties to each other. Losses are disallowed in transactions between related parties because losses are good for you as a taxpayer. Obviously, they're not good for businesses, but losses help you to reduce your taxes, so that's why they're disallowed, even if the selling price is at fair market value. So I could sell stock to my brother at the same price I could sell it in the open market, but because it was to my brother, that's the IRS just saying, nope, not allowed at all. Gains are generally taxed as capital gains, and no gain is recognized if the property is transferred between spouses. So generally, yeah, the IRS is going to say, you can't take the benefit of losses, but oh yeah, we'll take your tax on the gains. And then anytime you have gift taxes or transfers between spouses, that is generally just not recognized for the IRS. A, because, well, you're married and you're just giving each other something. It doesn't really matter who owns the car. Obviously, if divorce comes into play, then that matters. But if also the IRS views a married couple generally as married filing jointly or married filing separately, so views them as one unit for the purposes of taxes. So that's why any transfers between spouses, and this just goes well beyond this lesson, throughout the course, we're going to see that the IRS generally doesn't even view those as real transactions. Taxation: well, transactions between an individual and a 50% owned corporation are taxed as ordinary income. Holding period: this is 1 year being short-term and then more than 1 year long-term gain or loss. Holding periods do not transfer over in related party transactions, meaning it resets. Basis rules for related party transactions are the same as gift tax rules. We will see some overlap in this lesson that we see in gift tax lesson as well. However, it's going to be important things, so it's not overlap unnecessarily. And lastly, we'll talk about loans with imputed interest. What is this? Well, loans between related parties should have an interest rate charged at a rate that meets the applicable federal rates to avoid imputed interest. So if I get a loan from a parent for $1 million, I don't think they would ever give me a loan for $1 million, but maybe in another universe they would, and they give me a 1% interest rate or even a 0% interest rate if they really love me. The IRS is going to say, yeah, that's not allowed because you need to have taken out a loan. It's like unfair. You need to have taken out a loan with a bank, which would have been, let's say, 5% interest. The IRS getting involved in familial business. I mean, would they even find out about this? Probably not, but that's not me to get into here. If the loan doesn't charge interest or charges below this AFR, the IRS will treat it as if the required interest was being charged and impute the difference as interest income for the lender and interest expense for the borrower. So they're basically trying to reset this and say, we're going to make this into a legitimate transaction, and the parents will get interest income, and you got to pay interest expense. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.